Wall Street's tech darling Apple disappoints. Wall Street, the stock is down after its earnings numbers, not because it gave a sluggish outlook for the second quarter, but because the iPod number came in lower than expectations. 22 million units versus 25. Right. I mean, is this the sign of the diminishing iPod era for Apple?
Well, I think that there's some economic sensitivity that we didn't count on. I also, the expectations were way too high. I'm using now a $5 number for this year, and given the fact that expectations are way too high, it's very difficult to try to figure out what multiple to put on Apple. You know, Apple had a 35 multiple. That's not good enough. But if the growth rate's 28, then how do we give it a discount multiple too much to that? What I'm thinking is that, let's say you got to give it a haircut because it's declining in the rate of change. The rate of change of the business is declining. Maybe you put a 25 multiple on $5. And there you get where the stock is, which would, by the way, mean there's not a lot of upside for now. Apple is a company that has a very big retail component. Now, what's interesting, obviously, is that the tech component's keeping it down. The retail component should be moving it up because of what we see. And Mac sales were very good. Apple is in no man's land. I mean, a lot of people say, when do we start pulling the trigger on Apple? Well, I think that if it went to 20 times earnings, which would be an 8-point discount from its growth, and at 100, then you know you're right. And if it went to anything below that, then you have to buy it. The issue is that why buy it now? Why buy it in an area where you're not sure what the multiple is and the $5 number? I mean, why would you give it 30 times, which is what you need to do to buy it, given the fact that the growth rate's 28? Well, 28%. The answer would be, well, wait a second, we are willing to pay up to 2 times growth rate, but you're only willing to pay up to 2 times growth rate when everything's going right. Now we have genuine miss, okay? It was a genuine miss, so we cannot give it that bountiful multiple that we give to stocks that have genuine beats. So Apple, no man's land. Now, what happens if it never gets to my 100 level? Well, then I'm willing to miss it. Apple's become a stock that gone from being must-own to being a stock that you have to wait. Will I run the risk of missing a big turn in iPods? Absolutely. I'm willing to do that. One of the things that happens at this point in the broader cycle is that people sell tech. Now, I like Hewlett-Packard because it's a much lower multiple, and that Hewlett-Packard's just being tossed out. IBM's being tossed out. Intel's being tossed out. These companies don't have dividends to buoy them, and they aren't right in the cycle. Tech is mid-cycle, so and we're at early cycle buying. So it just doesn't fit the thesis of what's happening in the market. If I owned Apple, I wouldn't sell it. If I wanted to start a new position in Apple, I would wait. I can afford to miss Apple, is what I'm saying. I may not be able to afford to miss TJX, but I
saw that last night on Mad Money.
And TJX is an important stock because you want a retailer that if the Fed doesn't cut as aggressively, still makes money for you. It's a very confusing time for people, and I have to fall back on my discipline, which is that you got to figure out what the multiple is, and it's hard to figure out what the multiple is on a moving target like Apple.
So it's Apple no longer a no-brainer buy. You have to do
right. You have to recognize that the multiple's coming down because of the newfound inconsistency with Apple, and you can't pay that big multiple anymore.
Okay, Jim Cramer on Apple. It's a very confusing stock at this point.
Yes, it is.
And this is Wall Street Confidential. Stay tuned for more.